Alrighty. So fast track depreciation. So now one of the things that um, the government has done in the stimulus package is they've increased the instant asset write-off for businesses with less than a $500 million turnover. So they've done a couple of things here. You may have heard about this before the end of the financial year. It had been increased to $30,000, and it was only for businesses up to a $50 million turnover. So now they've made it so businesses can buy assets now and write them off before the end of this financial year. And I'll let Brian tell you a bit about that. And I've got a couple of questions for Brian that I know have already come through about this. So Brian, tell us a bit about how this is going to help us.
Yeah, sure. Okay. So if you buy an asset and it's installed ready for use before the 30th of June this year, and it's worth $150,000 or less, we can claim a tax deduction straight away. If you buy the asset between the 1st of July 2020 and the 30th of June 2021, no matter what the value of the asset is, you can claim 50% of the value of that asset in that 2021 tax year as a tax deduction. And in the current tax year, so before the 30th of June 2020, if the asset you buy is worth more than $150,000, you can claim 50% in this year. Just keep in mind that for cars, the luxury car threshold still applies, and that's just a tick under $60,000. So don't go out and buy some flash car expecting to get the whole lot back on tax, because it won't happen. Part of the rules there. The other thing I'd point out with this, I think it's really important, is don't go and buy assets just for the tax deduction. So what I mean by that is, let's say your tax rate is 30% and you buy an asset worth $100,000, your tax saving is $30,000. So that other 70 is gone unless you're using that asset to make your money. So I'd say, particularly given this situation where we really don't know what's going to happen and how much drain your cash flow is going to have over the next however long, I'd hold off buying any assets unless you really need them for work you're doing now, or you can see an opportunity where you can make money off having those assets.
Yeah, so if it's going to help you maybe pivot, so if you've got to change what you're doing but you need to buy a bit of equipment to do it, then maybe take advantage of the guaranteed loan and buy the asset and get the write-off as well. Does that work?
Yeah, exactly.
Yeah.
So if you were say a plumber and you thought it'd be nice to have an excavator but you didn't really need it, then I'd say, unless you've got a lot of cash sitting there, consider maybe not buying the excavator at this point just for the tax deduction, because if it's sitting in the shed not being used, there's really no point having it.
Yeah. Now, an asset is I mean, you're talking about equipment there. Getting questions as to what is an asset. Well, an asset is something that is a piece of equipment, or it could be furniture.
Yeah, look, anything that is sort of enduring. The benefit of having that is enduring. So a car, piece of equipment, furniture. It could be a new piece of software that you have developed. Anything like that.
Somebody's asked, can solar be considered an asset?
Yeah, solar panels could be considered an asset. You just have to make sure that they're used within the business for a tax deductible purpose.
Fantastic. And we've got to ask, can multiple assets be used towards the $150,000? Yes. In fact, you can have multiple assets up to $150,000. There's no cap on the number of assets, is there?
There's no cap on the number of assets. The only thing that you maybe need to be careful of is sometimes assets are considered a group for depreciation purposes. So the classic example, and it's obviously nowhere near this value, is a table and chairs. So someone bought a table and chairs, that would all be considered one asset for depreciation rules. If you can afford a table and chairs worth $150,000, good luck to you.
Yeah, I think you're doing pretty well, aren't you?
Yeah, that's the sort of thing you need to consider. So you're looking at a group of assets, and each one of them is less than 150, but they properly should be grouped together and they're over the 150.
Yep.
Then for depreciation purposes, they'd be grouped and you get 50% rather than the whole lot.
Good stuff.